A huge move. Think of that number and they're like, oh, this guy's a crazy gold bug, but it happened before. And once it happens, I'm going to get rid of my golds. I'm going to buy stuff. I'm not going to buy dollars. I'm not going to sell it for dollars. I'm going to buy things, and I'm going to call it the end of this game. I'm going to move on with my life, and we'll see what I do after that. But I know where the bell is because we've had 1980, so that's what I'm waiting for. And really, that was the point, because by revaluing, that gave FDR's government, or the Fed under him or beside him or whatever, the ability to print more money.
In today's news recap, Morgan Stanley raised its gold price forecast for the fourth quarter to $3,800, favoring gold, silver, and copper futures. Morgan Stanley published a report on the metal industry stating that a further weakening of the U.S. dollar should provide a tailwind for commodities. An increase in U.S. inflation could also attract inflows, and any stimulus policies from China would be an unexpected bullish factor for the industry. However, U.S. tariffs pose growth risks as the effect of stockpiling gradually fades. The bank prefers gold, silver, and COMEX copper futures. The bank expects tariffs on certain countries to be raised again starting August 1st, and tariffs on industries such as steel, aluminum, and copper may also affect and push up cost inflation in the industrial sector. Exports continue to support Chinese metal demand, but this support may weaken as tariff suspensions end. Morgan Stanley believes that the trends in the metal market this year will continue, with upside potential for COMEX copper, gold, and silver, but platinum is expected to stabilize after a roughly 50% rise. The bank has raised its fourth quarter target price for gold to $3,800 per ounce, supported by central bank and investment demand, driven by a weaker dollar, ETF bid, and ongoing uncertainty, while jewelry demand may recover as consumers adapt to higher prices. The bank forecasts gold prices $3,800 per ounce in quarter 4 2025, marking a multi-year top, as the bank expects $3,500 per ounce in quarter 1 2025, 2026, and $2,500 per ounce for the full years of 2026, 2027, and 2028, respectively. However, Morgan Stanley also points out that there are many uncertainties in the industry. Key issues include the path of U.S. tariffs on specific countries and metals, the outcome of the U.S. Section 232 investigation into critical minerals, and whether China will introduce more stimulus measures. Now, we'll show you the best clips of the latest interviews, but first, smash the subscribe button and turn on notifications so you do not miss out on our recaps. And check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trading the gold-silver ratio and increase your ounces. With this easy-to-read book, you'll know everything you need to know to stack efficiently so you don't have to rely on market commentators. Enjoy the episode.
What the Stablecoin Act, or the Genius Act, whatever they're calling it, can do is it can turn T-bills into a more liquid asset by making them tradable. If people are going to take stable coins as settlement for payment, then it turns T-bills into basically dollars. So the Fed wouldn't have to monetize that debt as quickly, theoretically. But sooner or later there's going to be a crisis anyway, and then everyone with stable coins is going to they're going to need cash, so they're going to have to sell out of their stable coins to get dollars, and there's going to be a rush on dollars, and then Fed's going to have to monetize it anyway, because all of this pyramid is still there, and all prices from today are still based on yesterday. No matter what the hell you do, there's no getting out of that ever. Just like there's no breaking the law of gravity, you cannot fly without counteracting gravity with an opposite force pushing down. It's not possible. So at that time, when suddenly there's a dollar crunch and everyone has to get out of their stable coins to pay their bills, right? Then the Fed's going to have to take those T-bills, turn them into dollars by buying the T-bills, giving dollars to whoever needs to give dollars to whoever has the stable coins. We're going to be in the same place we are now. So the most this can do is provide a little bit more liquidity on the top of the pyramid. But I guess an analogy would be like instead of like a really heavy brick on the top, right, on the top layer, you'd put, let's say, I don't know, something a little more jiggly, maybe like Jello on the top. So you can build it higher, but it's like a lot weaker, and like a little bit of sun can melt it and then it just falls over anyway. That's the analogy that just came to my head. Jello. Just a religious statement like, God is one, whatever, but you don't really know what that means. But you have to understand what it means that gold is the money. If the gold is the money, then every time the price of gold moves, it's revaluing the dollar. Gold doesn't actually get revalued. The dollar is being revalued. Now, the question is, are we talking about statutory revaluation or market-based revaluation? You just cited two examples, one being 1933, which was statutory, right? FDR just decided, maybe on some advisement, maybe on a whim. I remember I read when I was turning libertarian when I was younger, I was reading one of Glenn Beck's books, decided if he's the path I wanted to go on. Ultimately, no, it wasn't. He was an influence, but I never really went down his path. But he was talking about, I think in his book, Broke, how FDR just decided on a whim to make it 35. I don't know, he was just like flipping numbers in his head and he decided that was the one. Could be true, I don't know. And then you were talking about the revaluation in 1980, where the price of gold in the market that you could get a gold coin for to shop was what was being revalued, and that hit 872 or 850, wherever you want to count the top. And ultimately, these are really the same thing. Right? They're brought about in different ways, and that's but they are monetarily speaking, what is happening in the monetary system. It's the same thing. It just the difference is who's acting upon it. Like if a 50 kilogram weight drops on your head, you're not going to really care that much if it was, like, say, a meteor from God. Or let's say somebody had sinister would drop something on your head from 100 feet above you, or drop the piano on you. Either way, you're dead. It doesn't make a difference. So I don't think we're going to have a statutory gold revaluation. And what happens during a statutory gold revaluation? Well, you look at the price inflation statistics, which we have from the 1930s. And in April 1933, I think the deflationary, and I'm talking about consumer prices, the deflationary statistics were something like -9% a year. And then by about 10 to 12 months after the revaluation from 21 to 35, price inflation shot up to positive 10, 15% or something like that. Like a huge move. And really that was the point, because by revaluing, that gave FDR's government, or the Fed under him or beside him or whatever, the ability to print more money based on that gold revaluation, and then the inflation came from there. But in 1980, it was by the market itself, when the market decided that the other stuff on the Fed's balance sheet was not trustworthy. So it bid up the value of the gold to back the rest of the assets on the Fed's balance sheet, which is mostly debt, to 100%. And that made the rest of the debt trustworthy. Now, the question is, what percentage of gold backing the rest of the Fed's balance sheet would make the rest of the treasuries trustworthy to hold for people? And if we go to the 1980 numbers, it's something like $40,000 to $50,000. So people think of that number and they're like, oh, this guy's a crazy gold bug. But it happened before. And once it happens, I'm going to get rid of my gold. I'm going to buy stuff. I'm not going to buy dollars. I'm not going to sell it for dollars. I'm going to buy things. And I'm going to call it the end of this game. I'm going to move on with my life. And we'll see what I do after that. But I know where the bell is, because we've had 1980. So that's what I'm waiting for.
In today's news recap, Fidelity says the gold bull run is far from over. Despite already putting in a strong performance so far this year, Ian Sampson, multi-asset portfolio manager at Fidelity International, is confident gold's bull run can hold on over the long term. Having risen 27% in 2024, he noted the asset class is already up 28% over the year to 25 August, making it one of the best performing asset classes in Fidelity's multi-asset portfolios. However, rather than dial back any exposure to the yellow metal, Sampson said a mix of falling interest rates, sticky inflation, and subdued growth should all bolster the prospects for gold going forward. It should lead to a subdued dollar, which is gold's main competitor, as a safe haven and store of value, he said. We have never seen this scale of uncertainty and change around tariff policy, and the effects are yet to dissipate. Gold's status as the ultimate safe haven leaves it well placed for any further surprises. In addition, the unrelenting size of the U.S. budget deficit raises concerns about monetary debasement, which further boosts the long-term case for gold. Multiple countries, including China, India, and Turkey, are structurally increasing their holdings of gold in a bid to diversify exposure away from U.S. dollar, he said. Gold has long been a store of value and a diversifier, without the credit risk associated with paper currency reserves. More broadly, gold supply is very constrained, meaning even a small increase in portfolio holdings could move the dial. For instance, if foreign investors decide to move some of the $57 trillion they currently hold in U.S. assets, gold is a likely beneficiary. For much of the year, this had been through a combination of passive instruments that track the gold price directly and through a selection of gold miner equities. He said the latter has outperformed in the last few months, and we have taken the opportunity to book some profits, but retain exposure to the gold price. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps, and go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
Control without destroying the banking system. The government, it's hard to say how much they believe in what they're saying, these position papers, and how much is propaganda and how much they're just making it up. I don't know. But the way that they're thinking about it, they say, look, we have this gold. It's not really 42. If we just stop lying, then we have all this free money and we don't have to raise taxes and we don't have to increase the debt. It seems like free money, right? How could you go wrong? And if you don't understand that gold is money, and if you revalue the gold dollar ratio, you're not changing what money is, you're changing what the dollar is. And if you change what the dollar is, that affects all prices down the line very quickly, not overnight, but within, months. When FDR did it, it was a 66% revaluation. It took about a year to get to maximum price, consumer price inflation. So if you don't, I don't think anyone in the government understands that gold is the money right now. And because they don't understand that, they see this as like a mathematical trick that can just, give them manna from heaven, free money. And they say, like, why don't we just do that? And then the only reason they don't, I think, is because maybe there's some traditionalist people, or maybe they don't fully buy into their voodoo. And they're like, maybe this is not such a good idea. It's like Louis C.K.'s famous comedy bit, of course, but maybe, of course, free money is great, but maybe destroying the dollar isn't such a good idea. They're not sure about it. So we'll see what they do. And if they don't do it, the market's going to do it anyway. That's always the either or. When we start playing the inflationary game, you are playing the game of the currency versus the banks. You can save one, but not the other. And now, as you go up the pyramid, you can juggle, right? So as we go up the pyramid, this pyramid, let's say it started in 1933 with that initial revaluation, then you can juggle that pyramid and only hike when price inflation goes higher, when consumer prices go higher faster, and cut only when they stop accelerating as fast. And the reason you can keep juggling is because of the analogy that I often use, the apple tree, the orange tree in your backyard, right? If you have incredible production, you don't notice that your neighbor is stealing from you. But if your neighbor invites his cronies to his your backdoor neighbor, and they want to eat more and more and more oranges, which is the equivalent of the government growing bigger and bigger and bigger, because that's how it always happens, then you can keep consumer prices lower by increasing productivity. But there's a point where you can't increase productivity any longer, and you're overburdening the slaves, and they can't make the tree any more productive. So at that point you have to start cutting into an accelerating consumer prices environment, which is where the Federal Reserve is headed now, because this is what just happened like a week or two ago, right? They were urging Powell the Trump administration was urging Powell to cut, And he was saying, he hinted, no, he's not going to do it because consumer prices are rising too fast. And then he came out in Jackson Hole and said, well, we're going to cut now. And then gold and silver jumped. Consumer prices are rising faster than at any time from 1980 to just before COVID. So they're going to be cutting into a higher consumer price environment. And that means they will destroy the currency. Until now, they've always only cut into what they call recessions, when consumer prices stop rising and you have this huge banking crisis. So you can pick, I'll save the banks, and the currency will level out in consumer prices. But now they can either trigger hyperinflation by cutting to zero in an environment of very fast rising prices, or they can not cut at all and let the banks fall, and then everything goes with it, and all prices fall, consumer prices too, but they fall the slowest compared to everything else, including assets like stocks, bonds, Bitcoin, all those other things. Consumer prices still fall, but however it goes, it doesn't make a difference for gold and silver holders because all the purchasing power goes into those metals anyway.
What do you think of Rafi's take? Do you agree that silver is still massively undervalued and that a return to the 1980 Dow to silver ratio could drive it toward $2,400 an ounce? Or do you think this big reset scenario is overblown? Is it a coming reality? Or just wishful thinking and market hype? Post your honest opinion in the comments below and share your own gold and silver price predictions with the Stacker community. Now, check out this next video right here. It's the perfect follow-up for you. I'll see you on the other side.